I'm Aoife Devitt, and welcome to this week's Markets Happy Hour podcast. We are recording this in the evening London time, late afternoon US time on Thursday, the 9th of July. And I'm delighted to be joined here by Adam Berger, who I've known for years at Wellington. Welcome, Adam. Thank you for joining us here.
Oh, thank you so much. It's a pleasure.
Well, with no further ado, let me bring up the slides. I've called this week's podcast Midsummer Deja Vu, as we are sitting here in Europe in the midst of another heat wave. It seems like deja vu all over again from just a few weeks ago. The school children are suffering, and generally the buildings are creaking under the heat. That's the mirage there we have. There's also a bit of a deja vu in terms of markets because we have moved from the geopolitical norm, which was the friction in the Middle East, and then we had a memorandum of understanding and things had settled. And now we seem to be going back to a more, again, kinetic action in the Middle East. So there is a bit of a sense of deja vu and us sort of cycling back into that kind of market mood. As usual, we will discuss inflation, interest rates, geopolitics, equity markets, and other asset classes. And as I mentioned, deja vu all over again. We're going to ask what we should make of the new Fed policy. Because geopolitics have flared up, we're also seeing a little bit of trade tensions flaring up. Just this week, I was already in Spain, and it seemed in the middle of the week then President Trump has suggested that he would cut off trade with Spain as a reaction to Spain closing airspace to planes involved in the Iran war. So a bit of deja vu again in terms of some of the rather sudden knee-jerk trade policies. And we're going to look at how markets are taking stock of all of this. So here's Adam, Senior Managing Director, Partner, and Multi-Asset Strategist. And as I mentioned, I've known Adam for many years since my time as CIO in Chicago Police. So thank you, Adam. And we're going to be cycling through many different topics. So thank you for agreeing to come here.
My pleasure. No, and this is great. I think you've got a great lineup set up for us.
Fantastic. Well, we'd always kick off with inflation because this is really our kind of bottom line in terms of all other policies. It seems that the roads lead to inflation and lead from inflation. So what we've been examining over the last really months has been the convergence of inflation really around the coming down and then expectations and whether expectations have diverged or converged. It seems they are now on the rise. Interestingly, just as inflation itself seems to be picking up again and on the rise. Whether that's to do with the oil price that's recently jumped again, it has got, this chart only shows it close to 73 a barrel, but we know it had reached almost touched as high as 80. And equally that the forecasts for price rises are the highest since they have been since 2023. So consumers are now very much in the camp that inflation is not in the rearview mirror and is something to worry about. And this is also something on the Fed's mind. So I'd love to get your current, whether it's a house view or a personal view in terms of where we sit on this inflation continuum.
Yep. There's no, there's single house view at Wellington, just given the breadth and diversity of PMs. Even within an asset class, we'll have multiple PMs. Part of our philosophy is not to have a CIO and a top-down house view that everyone has to conform to. Having said that, I would say, just by way of backdrop, where we in our multi-asset team manage tactical portfolios for clients, we are modestly long duration here, and the view is, I think we wouldn't have that position if we really were concerned about inflation. So I do think, and this is going to be maybe a bit of a theme across our discussion today, it's going to be bumpy. The path is definitely not linear, but we don't really see things falling apart in inflation. If we did, that would not be a good environment where you want to be long duration. The flip side of that is I would say we're not long duration because we're expecting rates to necessarily move down dramatically. It's really more of think of it almost as a carry trade. We just think we're getting a fair compensation here to own duration, in global government bonds. Yes, there's obviously some risk of things backing up, but the flip side is the nominal and real yield are relatively attractive. So we like that. And in that sense, we're less concerned. To pivot maybe and give a bit of a personal view, again, I feel like what we're seeing in the consumer and the chart on the left, the fact that consumer concern about inflation has picked up, I think that is a little bit of a rearview mirror phenomenon, and just thinking about what happened to oil prices after the conflict. And again, if it turns out we are still on a normalization path, even with some bumps along the way, I think that should come down over time. But you're right to flag that, because I do think if we really get entrenched consumer and labor expectation of inflation being really sticky and high for a long term, that is a potential risk to the economy.
And let's take this into our discussion on geopolitics then a little bit, because it does seem that the only reason geopolitics ever seems to affect investor sentiment is when it moves the oil price. There may be a little bit of a kerfuffle when there is another trade announcement. We know that the Spanish market sold off. I'm not sure many US investors will be that exposed to Spanish markets anyway. But there is, I mean, does geopolitics, has it stopped mattering to investors for the most part, unless it directly affects a component input like oil here?
I think that's fair, but I do think the trade, I think I could see a world where trade or technology as well, in terms of free flow of technology, could disrupt things. I think if you think about the equity market in the US in particular, is at the moment so driven by technology that if there was a notable pivot because of a geopolitical event away from the idea that we're going to be able to get access to supply chains and what we need, I think that could pose a risk. I just don't think that's what's been in the headlines. I think it has been oil.
Okay, so not to still bear in mind that trade could still have the potential to upset expectations. And then the other thing on consumer and inflation, I mean, clearly we've seen the price of iPhones go up, or the price of Macs. Maybe the phones haven't followed yet, but they're likely to follow. So it's not just energy anymore. It's really turned into what may be deemed a consumer staple more than a discretionary item, the phones. And clearly, if this is occurring, the reason this is occurring is because of the input costs have risen dramatically. And given the demand for chips, etc., and compute, there is not likely to be any subsidence in this input cost pressure. So, how do you see inflation maybe having an impact on corporate earnings? Do you think that this has been well managed, and is there enough slack in the system to absorb some of this, or will companies simply have the pricing power to pass it through, or do you see this having any kind of potential to threaten company earnings?
So I worry about it more on the consumption growth side. At a gut level, I think companies will be able to pass it through only because the overall backdrop is still quite positive, meaning for all of the concern about things could go wrong, the economy is still doing quite well. We still have in the US, we're still lapping fiscal stimulus, right? A year ago, we did not have the fiscal package from last summer. That's going to the benefits will certainly run through 2026. As we get into Q3 and Q4, we will have had, the one big beautiful bill will have been passed. But I still think there's that fiscal impulse is there. I think as long as that's there, growth is strong, and I think there's ability for consumers to absorb some of these hikes. I think stagflation is the real worry. I think the market can process and can handle inflation if it's in the context of a healthy, real growth backdrop.
Very interesting. And then just you have already brought in the topic of interest rates, and the only headline I have this week is the Fed is Kevin Warsh, who's rethinking forward guidance and why. I thought it was interesting to really drill into why it is that he's so opposed to this steady drip feed of no surprises, well telegraphed Fed messaging. And in this case, it seems to be that he thinks it preserves his flexibility. If he were to be able to pivot or to address something suddenly and to really swoop in, and that maybe when policies have been telegraphed so well in advance, it takes away some of that flexibility. Do you think that this will affect markets negatively, not getting the drip feed they're used to, or do you think there's some merit in that preference for less is more?
I think there's a little bit of both. I think, and again, when I chat with colleagues who are much more expert on this than I am, I think that there's sort of an intellectual honesty argument to it. I think as much as the Fed tries to telegraph and likes this idea, there was a notion of, let us sort of, leave a trail of breadcrumbs. I think the truth behind that is that even the people laying that path know that it could be disrupted, right? All it takes is one or two big surprises in terms of announcements, and all of a sudden they can pivot. So I think it's more a recognition that when we telegraph, we may be right 70% of the time, but we're going to be wrong 30% of the time. And it's not clear that it benefits the market to say something when, in point of fact, when they're confronted with the realities, that could change. I think what that means, though, if we are sort of being more honest about it, it probably does create a little more volatility, but I think probably around the Fed announcements, because it is going to perhaps be a little more opaque what they're thinking in between meetings. And with less new information, I mean, I guess two things could happen. My baseline would be with less new information, markets should move less. Of course, it's also possible with less new information, you'll get more opinion and prognosticators, and the market will start moving on that. But I think you might see more or bigger moves around the announcements and more calm in between them. But
And,
again, that's really a hypothesis.
and speaking of information, it seems like not only the World Cup, but any outcome, whether it's the current upcoming midterms or the World Cup, so much has been now diverted to the betting markets. Which is extraordinary in terms of reading any real kind of predictive value into some of these, given in some cases, some of the numbers of trades are perhaps quite small and they could even be distorted by that. It's not as if it is a representative sample. But given we've had a lot of back and forth around some official data, we've had revisions backwards, we've had missing data for periods. There were some cutbacks in some of the offices that generated the data, and we're going to get less data from the Fed. So, do you think that this probably leads to a deterioration in the quality of data and the trustworthiness of data, given the patchiness of it, and the fact that we're not getting as much, and the fact that now half the market seems to be looking to the betting markets?
So I worry about the betting market piece, but the other doesn't trouble me as much. I don't think I think having less doesn't imply lower quality or less trustworthy. I think it is just a deliberate decision, and frankly, I think the pace of actual releases will be high. It's more the Fed signaling its intentions. So I think that's the piece the market will have to guess, and again, we'll see how much volatility that guessing create more volatility, or in the absence of new information, does it not? The betting markets, to your point, I think it's such a small. I mean, the interesting thing, right? If we're thinking about the probability of a Fed hike, we're typically getting that from the futures market, and that is a massive market with lots of real players transacting, hundreds of millions or billions of dollars in that space. So I think, again, it's not that it's always right, but there is real money behind that. It's not just speculation. It's not subject to manipulation. I think if people are looking to the betting markets, you're right to flag, that may be a small number, especially for something like a treasury. Relative to the size of the treasury market, a very small number of people, I think, are doing that on one of the prediction market sites. So I think I would take that with a grain of salt. But you're right, there's a risk that creates a headline and that creates noise. And right, that is the one problem with the Fed being arguably a little more silent is, does something else step in to fill the void? And if that may be counterproductive. The flip side, of course, as a firm that does active management, that could be a great opportunity for active managers to take advantage of what's really going to just be noise in the market.
Well, speaking of filling the void, I had to have a nice segue there. Let's look at where there has been assets flowing in to fill a void in momentum. And momentum seems to have been lacking in the last week, at least the kind of momentum we've been used to seeing. There's discussion of this TMT turnaround. I don't have this particular chart, but there has been a great K-shaped chart. And instead of the usual K-shape we've been looking at in terms of outcome for consumers, this K-shape shows the winners and the losers of the whole AI trade today, showing the winners being clearly the semiconductors and that piece of the value chain, the losers being some of the erstwhile winners, some of the Mag 7 now being referred to as the Lag 7. So there's been that gap. We've seen also entities such as Alibaba absorb some of the pro AI sentiment. We can also see in the top left here token expenditure having doubled. We've seen a lot of links between token expenditure and productivity, as well as the size of firms. Again, correlation, causation, not necessarily clear, but equally we have seen that pulling back. And whether that is something more concerning or just a single data point that's showing some of that kind of, as you mentioned, bumps in the road and maybe lumpiness in some of these trades. So I've entitled the slide Trouble in Paradise. And I'd just love to get your thoughts on the current movement in equity markets.
Yep. And here again, I'm going to channel my colleagues at Wellington who are the experts and really follow these companies closely. I do think, we don't see meaningful trouble in paradise. I think, in both of these charts show a dip, and maybe a dip is not fair. It's a little bit stronger than a dip, but the path of change and certainly the market's reaction to what is a very dramatically changing fundamental backdrop is always going to be bumpy. They're going to get it wrong. There are times when markets will over extrapolate to the upside, and then they may pivot and say, "Oh, we got that wrong. We're gonna shift to the downside." Let me spend just a minute on the token chart. In some ways, to me, that is such a validation. I mean, sorry, leaving the recent drop aside, it's a real validation of a business model people were questioning. Like, can people make money in AI? Is this adding value for people? And this is not a proof statement of that, but I think the fact that the token cost went up so dramatically over this is a sign that there was real demand and that companies were deciding we can use this technology. We do get value from it. Again, I think that the dip is probably, the market assimilating something, processing it. Maybe it's a little bit of more supply coming online. But I think the overall thesis that more companies will find a way to use this technology and actually have it add value for them in a sense where they really want to spend it. I think the demand story is intact. And again, just to step back even one more level, our overall thesis is that the world is constrained on compute supply, and that demand for computing power is going to exceed supply of available computing power for the foreseeable future. Not forever, but for the foreseeable future. As long as that's the case, I think we're still in paradise. I think this trade still has room to run. I think there will be pivots in the winners and losers and sort of who has the upper hand, and that may zig and zag a little bit. I mean, on one level, obviously the hyperscalers and the semi manufacturers are both levered to the cycle, but one is the other's customer. So that the relative benefit, or who's sort of gaining at the margin, you can see some zigging and zagging there. And I think the chart on the right of just as you said, or just the idea more broadly of the lag 7, I think is partly just a reflection of the fact that this is a disruptive technology and there will be winners and losers. And that frankly is probably true of the Mag 7. We had an era where they all worked. The market as a whole was just underpricing the impact of this technology. As we've gotten a little more mature, I think there will be winners and losers from here, and at the market, and it'll be up to the market and investors to sort of figure out what those are.
Well, I think that's a great segue. We don't need to focus on the lag sevens, an older chart, but I still think it's a catchy name, and I think it's probably going to be a characteristic of the next few weeks. I'll come back to SpaceX because I think what you mentioned is a good segue to this AI boom, how many different factors. And in our world, we've been discussing total portfolio approach. It is definitely, it was described in a Financial Times article as a fuzzy but buzzy concept, in that there was clearly a lot of buzz related to it, but everybody had a different definition of what a total portfolio approach meant. There's a suggestion in this Pensions and Investments article that the AI boom is a perfect case study for a total portfolio approach, given that it can be a theme that is played in many different, say, traditional asset buckets of a portfolio, whether it's the infrastructure, real estate, the data center side of things with its private characteristics, less liquid, right through to clearly the equity market charts we've just been showing. And then even within that, plenty of room to diversify within that. And then, of course, private credit, whether or not that is ultimately aligned in terms of returns or whether private credit has a different mix. So it's very interesting to see a theme like this that really is just, there can be exposure across the board. Your thoughts on that in terms of whether this is a valid case study, and how investors can get a little piece of AI at many parts of the spectrum.
Yeah, no, I'd say kudos to P&I for flagging this, because I think it really is. I mean, I'm fascinated by TPA. I've talked to a number of global asset owners who pursue it in different ways. But I think what's always interesting, and I think what in my experience varies from organization to organization, is really where the rubber meets the road. How are allocation decisions made for a given, the idea of TPA, a big piece of it is not being wedded to a specific strategic asset allocation, not having a mindset where I have this allocation to private equity and I need to fill the bucket. And we know that can lead to suboptimal results if you're trying to build a portfolio that way. But the flip side is, if you take that out and say, I want to approach it a different way, you still have to decide for any given opportunity you're going to pursue, how does it fit in my portfolio? Does it work? Do I want it? And if I'm allocating it to, what am I selling to bring it into the mix? And you're also typically saying the whole idea of the total portfolio approach is, let me look through and understand and be deliberate about what is my exposure to a theme like AI? And I think you hit the nail on the head. It's tricky for an investment or a theme. Not everyone, not most themes don't have this characteristic where they are really everywhere. Maybe you could argue it's not really in the government bond market, but you have AI in public markets in the Mag 7. You have it in private markets in both early stage VC and growth equity and late stage VC companies that are sort of lining up to go public in the next several years. You have it in listed credit because what happens to Oracle's publicly traded bonds as they move into this space. But you also have it in private credit, as you pointed out, with lots of financing. And we see very, very different terms. There's a wide spectrum of what's being done in the private markets to support data center build out. And you have it in infrastructure, public and especially in private. So all these asset classes that, in theory are very different from each other may be levered to this trade. And so trying to, from a TPA perspective, understand both, even before you decide how much you want, how much do I have and where is that relative to my goal? I think this is a really interesting test case. I think it's a reminder of why this isn't easy. I think the right organizations will approach it thoughtfully, will be deliberate, will mastering the data you have and figuring out how to really understand what you own is critical. And then they'll be able to go beyond that and say, okay, this is what I have, what's optimal, and how do I get there?
Yeah, it's a great point. I mean, I suppose the question is, are you proactive about actually trying to spread this exposure across different asset classes to deliberately spread the risk? But then equally, as you mentioned, being aware of where your risks sit and the potential for quite a lot of correlated risk were there to be, say, a correction in some of that demand pattern that we mentioned earlier. And I did juxtapose this with a headline around one bank, HSBC, pulling back from riskier private lending. It's only one bank, one swallow does not a summer make, and one bank does not a crisis make. But I was suggesting just an indication that there has been perhaps a pulling back in some ways, and that clearly a little bit risk here. Love to hear your thoughts on private credit's been out of the headlines. There have been moments when it appears, surfaces, and we speak about redemptions, we speak about software exposure. Do you have any view on whether that sector is being well understood?
So I want to get there, but I want to go back to the one thing you said about TPA and AI, where I don't know that spreading the risk is necessarily the right thing. I actually think you want to think about where is the biggest asymmetry. Because if you think about if you could own a data center bond or a hyperscaler, and they're both levered to the AI thesis working out, but your upside in that data center is capped, it's more bond-like, and your upside in the hyperscaler is much greater. You don't necessarily you may not want to diversify. You may want to really think about the risk-adjusted return. Sorry. With that aside, let me turn to your second question on private credit. I have been surprised, and I talked to a lot of different types of investors, but probably more public pensions in the U.S. than any other. And I've been surprised at the continued momentum of interest in private credit over the last several years. I mean, it felt like it had been on a tear really almost for a decade. And that always makes me a little bit worried about crowding. I would acknowledge it is a huge space. I mean, the credit space in general, writ large, is enormous. And the idea that private credit may offer borrowers better terms, better ability to close, better flexibility, like there is room for this to really be a revolution and to take a big piece of the pie. So there's room for that. But I do worry about people going in maybe not with their eyes fully wide open. And I'd say that the biggest worry that I have is, I think about private credit as really being a creature of the GFC. The reason this asset class came into being in a meaningful way is because we had a global financial crisis and banks weren't lending, and private credit really stepped in and filled the gap. But that was, more than 15 years ago. And in the intervening period, we haven't had a protracted recession. You could count the COVID recession. You could probably measure that in weeks. We haven't had a default cycle. You had a little trouble in energy in the mid-teens, but you really haven't had meaningful defaults anywhere. So I just think it's ripe for overconfidence. And so to me, if I'm thinking about private credit, I would focus very much on a PM who has a fixed income mindset, who's more worried about return of capital than return on capital, who's not trying to squeeze every basis point of return, but really is thinking conservatively. And that also extends, this goes back to the HSBC point, to leverage. Historically, depending on the structure, too much leverage in private assets or private, exposures doesn't always end well. So I just think being prudent about how much leverage you're taking and how you'll be able to weather, a potential downturn or liquidity crisis. Again, I don't see that on the horizon. I talked about conditions being benign, but I do worry about, when it turns, could it be ugly?
Well, I think this is a nice segue to my last slide, but I just wanted to pick up. You mentioned private credit being a kind of a creature or a birth in the GFC. I also think it's a creature of private equity firms who have obviously needed this, and maybe it's related to that same point. But there is this kind of this quite a, say, a complex web of codependencies in that, whether it's private equity funds themselves with private credit arms, and it seems like that is now a fully diversified business model at this point, whether there's Chinese walls between them or not. And equally, then there's this codependency and interrelationship, which is something we're seeing all over the place in AI in terms of its demand, supply, kind of connections. So again, how these ultimately these relationships result in problems being either concealed or kicked down the road because it's in everyone's interest to do it. It is not a traditional arm's length type of relationship. Which brings me to the last slide, and we can comment on all of those kind of, I suppose, those the softer network effects of markets. This is the SpaceX list of share price targets coming out of Wall Street. Once they were the clock had been reached when they could actually release targets after that period. And it's remarkable just how aligned these 10 or so banks are in terms of their positive sentiment, bullishness regarding SpaceX, Morgan Stanley at the extreme 300. This is dismaying to me in a sense that there is so much convergence around a controversial name. But maybe I've got too cynical, been in this markets too long.
Well, I would just say, and I think one of the Wall Street, there was a Wall Street Journal. I don't, this is colored in sort of a salmon color, so I'm wondering if it came from the FT. But there was a Wall Street Journal article as well with a similar table making a similar point. And hearkening back to the late 1990s, it's unusual to see underwriters, not be favorable on the names they take public. I also think it's just, again, we're in a world. I would suspect we will get some cynics and skeptics out there, maybe on the short side of the hedge fund side, who will go public with more negative, more skeptical numbers. But I think people might also just, if you have a negative view, I wonder if there are folks who are just sort of keeping it to themselves and keeping a low profile and not splashing it out there, maybe just not even publishing research on it. So I do think there's a wide set of views there. But I think you described it as sort of frustrating. For me, I think about it a little bit as a worry indicator. I've been talking to clients a lot about, my view that we are not in an AI bubble today. There's a risk that we're building one, but I just don't think we're there for some of the reasons I shared earlier, and happy to go into more. But I think I look back to the 90s for signs that maybe we are. And when you see this, kind of, reaction of companies going public with like really bullish analyst views, maybe that's one more thing it's not on my checklist now, but that should sort of be on my checklist for, are we getting later in the cycle?
Well, I think that to bring this to an end, I would love to get your final thoughts, given you are a multi-asset strategist, on where you are seeing tilts happen today. We've spoken a little bit about equity market concentration. That is sort of working itself out in part. But, if you were to, and you've spoken about the need to look at fixed income mindsets when it comes to private credit, that gives you some diversification right there. Any kind of final thoughts to leave us with in terms of the portfolio construction, maybe of the next 5 years?
I would say highlight two themes. Just coming back to technology, I think we've all been burned, or not. Most investors have been burned by something going wrong and turning down, and the crashes and the painful periods really linger with us because it's where we struggle and where we struggle to deliver for our clients. But I think at times that can color people's sentiment, and we sort of have this idea that we can pretty easily sidestep those, and it's easy to get overconfident about that. And I bring that up only because as it relates to technology, I feel like, there's a lot to worry about. We talked about the valuations. I think the market spends a lot of time engaging with what can go wrong and maybe not enough time on what can go right. So I'm not making a call to overweight technology, but I would just be very aware as an asset owner or an investor, how much do you have and how underweight are you relative to the market? If you are very underweight, again, if you understand the rationale, if you have reasons for it, that's fine. But just recognize that even if you're right on a 3-year view, it could be a very painful ride to get there, and it may be hard to stick to that position. So I would encourage people to be very deliberate there. And then the other piece I'd flag, you mentioned fixed income. Um, you know, we've gotten so used to fixed income being the diversifier for equities. It was there in 2008. It was there 2001, 2003. It was there in the crash of 87. It wasn't there in 2022. And coming back to inflation, if inflation is the driver of the next bear market, you want something other than stocks and bonds in the portfolio. Having some real assets, having some absolute return strategies like a hedge fund portfolio is really going to help stabilize a portfolio if stocks and bonds both sell off at the same time, as we saw could happen. So I think those are two key trends I think investors should be aware of and thinking about today.
Well, Adam, it's always a joy to speak with you. Since we got to know each other, I've always loved your sessions, the strategy sessions where you come and really just think big issues and band them about, and there's never necessarily a sales pitch behind it. It's always been a great way to really discuss the marketplace of ideas. So thank you for coming here and for sowing a few more seeds of new ideas and for sharing your insights with us in the Markets Happy Hour podcast.
Thank you for having me. My pleasure.